an NFT bubble, a real estate bubble, or an everything bubble. Nowadays we are in all kinds of bubbles and nothing has popped yet. But there might be one bubble that everyone is overlooking, and that could be the ETF bubble. Now, this idea is not new, but it is a very interesting theory to look at. So in today's video we are going to try to answer the question, are we right now in the ETF bubble, and is this going to be the trigger or the black swan event that is going to push us over the edge and create a new economic crisis? That and more in today's video, but before we dive in, please do me a favor, hit that like button, subscribe, click the bell, click and all so that you don't miss anything. Leave me a comment or share with your friends if you think this is useful. Now let's dive straight into the content. Now when we are talking about ETFs, we mean ETFs and index funds, and although they're both very much similar, they both track a underlying value, there is a small difference in these products. That is one, the cost of owning them, the way you buy them, and the minimum requirement to purchase an ETF or an index fund. Index funds were created approximately 45 years ago by a guy named Jack Bogle. And the idea behind this product is very simple. Let's create something that is easy to use for everyone and where we can track the market, because knowing that 90% of all traders and stock pickers perform worse than the market, why not create something that follows the benchmark or follows the market? Then right away you beat 90% of all traders. And although Jack Bogle sadly passed away already, his products and his ideas live on. When he just created this product, Wall Street was not so enthusiastic about this idea, and it took a very long time for this product to pick up. But nowadays, ETFs are one of the most important financial instruments all over the globe. Right now, you can buy ETFs on pretty much anything. You can buy an ETF on an index fund, on certain commodities, on emerging markets, on pretty much any sector that you can think of, you can buy an ETF right now. And interesting to see is that a few very big names in the industry are pro-ETFs, and we have a very big name industry that is against ETFs. And let me tell you something a little bit more about that. The first name that is pro-ETFs is Warren Buffett. Well, this guy doesn't need an introduction anymore. I have put two links in the description to two other videos. Check it out after this video, where he publicly says that he's pro-ETFs, what the power of an ETF is, and why he advises you to buy one and hold one for the very long term. Another guy that's big in the industry is Michael Burry. This guy is also played by Christian Bale in the movie The Big Short, where Michael Burry was one of the few people who saw the credit crisis of 2008. And in 2019, Michael Burry said publicly that he was very much against ETFs and he saw a growing bubble that could be a danger for the entire market. In 2019, Michael Burry gave an interview to Bloomberg and he said the following: "Passive investing has removed price discovery from equity markets. The simple teasers and the models that get people into sectors, factors, indexes, or ETF and mutual funds mimicking those strategies. These do not require the security level analysis that's required for true price discovery." Later on, he also stated, "This is very much like the bubble in synthetic asset-backed CDOs before the great financial crisis, in the price setting in the market was not done by fundamental security level analysis, but by massive capital flow based on noble approved models of risk that proved to be untrue." So what he's actually saying, and where he has a fair point, is that once you start buying ETFs from, let's say, a certain index or a basket of certain stocks, that the value of those assets are rising. The ETF goes up and the price of the stock goes up, but they might not justify the absolute performance of that underlying asset. So if all the stocks are going up but some of the companies perform very, very bad, then it just doesn't justify anymore the price of the stock and the performance of the asset, or in this case the performance of the company. The part why I think that he's wrong is about the CDOs, because the CDOs in 2008 was like a basket of mortgages wrapped into a AAA rating. In other words, the bank saying these are top mortgages, people will pay off their debt, they are very, very low risk and you get a decent return. But actually the mortgages were pretty bad, and a lot of people were carrying these mortgages which they actually couldn't pay off. So the value of the basket was actually not a AAA rating, but should be a much lower rating. So if you want to learn more about that, I really advise you to watch the movie The Big Short, where they really explain how that exactly works. And although those CDOs were bad, the ETFs do not have to be bad, because if you have certain companies in that ETF, everything is public. You can search their companies, you can look at the balance sheets, you can look at the profit and loss. There is just so much more information, and where that with the CDOs was much harder to discover. And so where I think like with the CDOs were not so transparent, ETFs are very transparent. Now, important to mention is that ETF tracks an underlying value for, let's say in this case, an index. So once you buy an ETF, you don't really buy all the stocks that are in the index. You're just buying the so-called paper ETF unit. And those ETF units are then just bought and sold by the ETF holders. And the creation and the destruction of these ETFs can only be done by the person or the organization who creates all these ETFs. For example, Vanguard. So what is then the big difference between Michael Burry and Warren Buffett? Well, Michael Burry looks on a much smaller time frame than Warren Buffett does. He looks for the next 2 years, 4 years, 6 years, and Warren Buffett likes to buy and hold stocks and ETFs for a lifetime. So he's really looking at what will the price be in 30, 40, 50 years from now. And to be honest, both can be right at this point right now. ETFs can go down within the next year or 2 or 3 or 4. But if we would buy an ETF on, let's say, the S&P 500, and if you look at the track record of the S&P 500 for the last 50 to 100 years, then on a long time frame, the price just goes up and up and up. So if you would buy an ETF today and just hold it for 40 years, you might be very happy and thank yourself in the future for doing so. So to answer really the question, are we in the ETF bubble, we need to dig a little bit deeper into the fundamentals. ETFs are becoming more and more popular, like I said earlier. Where about 10 years ago, ETFs were bought for a total amount of $2 trillion. Today, that is more than $11 trillion, and that just shows how powerful these instruments can be and how popular they got in the last decade. But important to notice is that these numbers are not traded volume, because the traded volume on a daily basis is only 5%. And then with that being said, that means that 95% of all traded volume during the day are other products. For example, just spot trading on regular stocks. And only active trading sets new prices. For example, if I have a stock and I want to sell it to you for $100 and you want to buy it for $100, then the new price is $100. If in a week you want to sell it back to me for $101 and I accept that, then the new price is $101. So only active trading, supply and demand, is what sets new prices. And let's say everyone would move over to a more passive way of investing and want to be exposed to the market. So everyone would move over to ETFs. Would that cause a problem? Well, not really, because we just said that active trading causes new prices. So if, let's say, not 5% of the daily volume is in ETFs, but 90 or 95% and just a little bit is really into active trading, then we are seeing much more overvaluation or undervaluation, because just a little bit of liquidity in a market then can just pump and dump certain prices. So once a stock is undervalued and traders see that, they are maybe performing okay with their ETF, but they will move out of the more passive ETF into active trading to take an advantage of that undervaluation of that certain stock to take the ride up again and then outperform the market or the certain ETF. So you could say that ETFs and the active trading kind of keep each other in balance. Once there goes more money into ETFs, undervaluation or overvaluation exists because of a tiny pool of liquidity, and once a lot of people are actively trading, not making a lot of profit anymore, and the ETFs is performing, then you'll see the liquidity going back into the ETF pool. So in this case, they're keeping each other a little bit into balance. And next to that, ETFs also have a lot of pros. It's very easy to diversify. For example, again, the S&P and the 500. Just a few clicks on a button and you own the entire index. Usually it's also much cheaper than having a fund manager working for you. You can buy or sell an ETF already for 0.01%, where an hedge funds manager usually asks 1.5% per year. And if he then still needs to outperform the market, the hedge funds manager really need to work hard. Also, most fund managers are not able to compete or beat the market in an extensive period of time. They might have 1 or 2 good years, but if you want to invest for 10, 20, 30 years in a row, so far barely anyone has succeeded to outperform the market on a long period of time. And fourth is then the high chance of getting a good return on your investment on a long period of time. Like we said earlier before, if you have an ETF that, let's say, tracks a certain index or market, if you then hold that ETF for 10, 20, 30 years, you are almost guaranteed that you will make a return on your money, where for the hedge funds manager, it is always a bit of a guess because you have no idea what they're going to buy or what they're going to sell in the near future. One of the negatives of ETFs is that once ETFs are sold, and let's say the ETFs really holds also the stocks, that once they're being sold, they kind of sell off all the stocks in that certain basket, in that certain ETF. So you could ask yourself, once everyone starts selling those ETFs, isn't everything going down? Yes, that's true, but on the same hand, if we are really into a correction or in a crisis, isn't everything being sold off? Crypto, real estate, stocks, pretty much everything then goes to cash or to more secure stocks, or maybe even to safe havens like gold or Bitcoin. Another minus that I could think of is that you will never outperform the market because an ETF tracks the market. Number 3 is that you will not really learn and grow because an ETF is very passive. It's very easy. You can just simply make an account at a broker, Google for the ETF, the ticker, and then just buy it. With 2 mouse clicks, you're done. It is super simple. But to really understand the financial world, the financial products, how they work, what they're buying, you are kind of limiting yourself to future growth. Number 4, although this one is not super powerful, is that you usually have a little bit less dividend, is when you are only buying dividend stocks. But of course, those dividend stocks can also underperform where an ETF could perform much better. So at the end of the day, you could still kind of underperform with your dividend stocks compared to an ETF. But it has to be said that an ETF generally gives less or even zero dividend than just cold hard dividend stocks. And last but not least is maybe the risk of currencies is, let's say you buy an ETF in Australia or in Canada to the Canadian dollar, Australian dollar, that those currencies compared to your currencies will go up and down. And then maybe your ETF is up a few percent a year, but the currency went down and you're kind of still ending up with zero. So are we right now in ETF bubble? Well, if you ask me, the answer is no. And my arguments will be all the fundamentals that I mentioned earlier in this video. And usually bubbles burst with a black swan event, something that no one saw coming. For example, the credit crisis or the corona dump, why stocks went completely down the drain in a matter of days. And usually with these crashes, we look in hindsight and said, oh, if we only knew that, or it makes so much sense. And all these bubbles like the real estate or the everything bubble or the ETF bubble is being talked about already so many times that it would not make sense that this then would be the trigger. What will be the trigger for the next crash? Well, that's anyone's guess. But I hope that this video helped you a bit, that you learn more. And if you think that's useful, then please do me a favor, share also this video with your friends. And of course, also hit that like button and subscribe. And I'll see you guys in the next one. Thank you so much. Bye bye.